Hi, Larry Gaines, PowerCycleTrading.com. In this video, I wanted to kind of do a follow-up on a calendar diagonal spread set up on Intel. So just first off, let me put it up to a daily time frame. So this is a really great strategy for when you think you're seeing some kind of a bottom to a stock or security, and then you're waiting for it to maybe it rolls sideways and then starts going up, and you can make this into a directional kind of trade. But also, in the meantime, taking advantage of time decay or theta decay, which is what you get from a income calendar spread. So it's a combination of a calendar spread, and then we add a vertical component to it and makes what we call a calendar diagonal. So in this setup, this is a daily chart of Intel. You can see it came off real hard, and there's good support right here at 42. So if you look at the 42 level, good support. Is trying to hold that support, starting to turn up. So on the 29th right here, set up a calendar diagonal. And so there are now a couple things you can do. We set up the calendar diagonal with the first target to 47, which it hit yesterday. So 47 based on all this price activity through here. And then the next price target is up here to or towards that 200-day moving average, which comes in at about $48, $49. So let's take a look and I'll show you what this trade setup looks like. So basically set up this trade by going out and buying the 19 July series 45 call. So if we look at the 19 July, let me show you how many days out that is. So the 19 July call, this was done back on the 29th. So currently 37 days out. So this is a kind of a longer duration call that was bought and then sold against it. The 47 call, the 28 June call right here. So you can see the June 28 series right now is 16 days out. So we've got that time element, between this. So the 19 July, 37 days out, this 16. So this trade strategy takes advantage of the theta decay that you get from a shorter duration option, which we're short here, and then we're long the longer duration option here, so less theta. So we're playing that for time decay, but it's also a vertical component to it by being long the 19 July 45 call, and then selling the 47 call here. So that's the vertical element. So when this was set up, the 45 call was going at $1.48. Now it's $2.42. So a nice little profit there. But sold the 47 call, the 28 series 47 call at 38 cents. So that's up against us 72 cents. But all in all, it's up about $56, and the risk is really pretty low. It's $110. So nice return. Now the other thing we could do, what I could do here is I could close out this 47 call. So I'd have to buy that back at 72 cents. So I'll take a little bit of a loss there. So 12, 11, 10, 9, 8. So about a 23, let's see, that'd be about a 32 cent loss on that. So about a 34 cent loss on that if I bought it back at 72. And then that would adjust up the cost of this 45 call by $34. So then that would be going for, let's take a look. So then I could roll that up, and that adjust that price would be then the 45 call at $1.82. Okay, but then what I could do is I could come out and I could sell the 5 July series 49 call further out of the money, bring in $31 here. So by doing that, then I'm rolling this trade up and out a little bit, so I can still play it for bigger upside move, potentially up here to the maybe that close to that 48, 49 level, which would be a huge profit on this. So this theoretically could make over $250. So a really cool strategy, takes advantage of time decay from what we call the income calendar, and then adds a spread component to it, and that's what we call a calendar diagonal. And if you'd like to learn more about those types of trades, I'll be doing a complete workshop on it this Saturday. So use the link below, and hopefully I'll see you Saturday.